a concise approach to top-down market strategies and the forces affecting investments. That's the spoken word on investing.
Let's get the spoken word now on stock quote screens. That's something different. From our Chief Equity Strategist, John Blank, who joins us via Skype from the West Coast. So, John, you wrote recently in the Zacks Industry Rank Analysis that quote screens hold big money stocks. Does that mean that you're saying that the old-fashioned official outcry, the open outcry is officially dead?
It's officially dead. And in fact, the CME shut the last of the major trading floors here in February. The only thing that left in terms of open outcry is custom options trading in person, which means, going in with a specific specialized options order. Other than that, it's dead, and it's all migrated to screens. But it goes beyond that, Terry. It goes beyond the futures markets. The rest of this marketplace is quotes for stocks, which is the NASDAQ, quotes for options themselves, the CBOE, and quotes for bonds, which is now done through a group called Market Access. And it even goes further into another company called Market, which is putting out the PMIs and all the leading indicators and all the other tracing information from financial markets that is on quote screens. So the bottom line is when you have these electronic trading screens kicking up transactions, buy or sell, this is a huge growth business, and it's a profitable one.
All right, and this is a situation that's been kind of blossoming and opening up for a while now, for any of us who've been following the markets for any length of time. But you think that the situation itself makes a particular statement about the stock market?
Yeah, I think it does, Terry. I think what we want to learn from this is a cautionary tale. Because if this is transaction volumes and trading volumes are getting big in options, futures, bonds, and stocks, and that's the growth industry, take a step back and think about it. That could mean froth and speculation and leverage is getting a little too high in this economy, and that's not good news. So the other problem you have here when you look at market access or market as stocks is one of them in particular has a 12 price to sales ratio, but 3 times as high as it should be. So what you're learning here is there's a lot of momentum trading, a lot of excess trading, and probably a lot of froth that's coming in implied by all these companies doing so well.
So what is specifically does the average investor have to look out for with regard to these types of stocks?
Well, clearly these are not long-term investment vehicles right now. I would not tell anybody to buy any of these stocks for more than the next 1 to 3 months. That's the key point. They're trading stocks. The Zacks rank is indicating that. That's the correct interpretation. And you should not put these in as investment vehicles over a year or two at this point in time because they're way too highly priced. And you will see downgrades in earning estimates just like upgrades. And all these in 3 to 6 to 9 to 12 months can go the other way. So what this tells us is that we may be in a top, that there's still some momentum for these stocks for the next 1 to 3 months, and that's a trade you can make, but it's a trade, not an investment.
All right, run me down on those stock names once again for viewers who might have missed it at the top when you were
there's 2 stocks that are Zacks ranked number 1, Market, MRKT, and Market Access, which has a similar ticker but different. And then beyond that, you have NASDAQ, and you have CME, and you have CBOE, which is the options exchange. Those 5 are in there. The 6th is ICE, which is a futures exchange as well, and that makes up the whole industry. All of them, all 6 are either Zacks ranked 1 or 2.
All right, do you own any?
No, I do not.
All right, thanks, John. Appreciate the information. There you have it, the spoken word on stock screens with John Blank. I'm Terry Ruffalo. Sit up, John.